Hey traders, this is Blake Morrow with Trader Summit, and we have an early special edition with Mr. Jim Welsh of Macro Tides. Good to see you, Jim.
Good to see you, Blake. Thank you.
And you know, it's fresh off the heels of a few central banks. We had the Federal Reserve. Yes, them.
Yeah, all them.
Yeah, them. We had the Fed. We had also the Norges Central Bank. We had the Swiss National Bank. We had the Bank of England. So we've had a few central banks meet. Seen some volatility. I want to start with let's just go with the Fed. What were your takeaways after the Powell testimony, and then listening to some of the comments that came from Janet Yellen right at the same time?
Yeah. Well, again, I think markets are on edge, and so any comment that is either mistaken or people can read into, you get an overreaction. I think that was part of yesterday. In addition, people, I think, went into the Fed meeting kind of thinking that, okay, they go 25, they're going to indicate that, that will be pretty much it. And the market's going to rally, especially the equity market. And I think part of it, too, is you're expecting a rally because Powell's going to say something somewhat friendly. When it doesn't happen and then things start to weaken, then it's like, okay, every man for himself. And that's what the last 15, 20 minutes of yesterday look like. And then the programs kick in, you hit some stops, and it just cascades. And a lot of it, I think, was just an overreaction. Some of this should just be basic common sense. Unfortunately, for majority of people on Wall Street, it isn't. The Fed is in a position I thought that they would raise by 25, because to do otherwise would have maybe given the wrong signal, like, wow, the problems are worse than what we thought. Yeah. Powell tried to be reassuring that, the banking system is sound. And an era of confidence, calm confidence, all that stuff. He made a comment about real estate in the small banks. And to me, what went through my mind, Blake, is, as you might remember, in 2007, Bernanke said that the credit problem with housing was contained. The junk credit. There was a phrase, I can't remember what it was. And obviously it proved to be just, extraordinarily wrong. And so to me, there is going to be a problem with commercial real estate. And I wrote on Monday what the percentage is. I think it's north of 70% of commercial real estate loans come from the small banking systems, and they provide about 38% of the credit. So to me, you've got two things going on here. One, you have the short-term liquidity crunch as deposits flow out of those banks and the scramble. And then the second impact is going to be an economic impact as these banks pull back on their lending. And there's just no way that's not going to happen. As you know, over the last 3-4 months, we've shown the chart of the increase in lending standards, and they've gotten to a level that in the last 40, 50, 35 years, there's been a recession every time, because you're talking about liquidity not flowing into the economy. And that's kind of the lifeblood of our economy. And so big banks have already been pulling back relative to increasing lending standards, and the small banks are going to do it. I just think they're likely to be more aggressive. And Powell, I think, attempted to kind of downplay that a little bit. Yes, there's going to be a contraction in credit from these things, but we don't know how much it's going to be. I just think that going prior to this, my odds were like we're going into a recession later this year. Things are going to slow down mid-year and beyond. And this only, I think, creates the risk that a modest slowdown does become a recession, or a recession becomes a more challenging recession. Yeah. Because as you go into a recession, real estate values, commercial real estate values are going to come down. And that means the banks pull back lending. Then some of those companies that have to refinance loans are going to have it, be more difficult. The spread will be wider. So to me, it's one of those things, once you weaken, these are the things that then start to accelerate that weakness. Yeah. And what everyone thought, a month ago, no, we're not going to have a recession, no even soft landing. We're going to have no lending. And these are the things that I think gradually start like a snowball going downhill, that later this year and early next year, or next year in terms of the commercial real estate stuff, starts to come out of the woodwork. So Powell's comment about downplaying the real estate impact on the small banks and so forth, what went through my mind is, geez, that could be, his Bernanke that that he made. Was it? Gosh, I can't remember what it was.
It was just before the
yeah, but his ex phrase was like relative to the crappy loan, subprime lending.
Yeah,
that's what it was. Is contained.
Jim, it's I was trying to think of the name of there's somebody on Twitter, and if I could remember from just a few hours ago, who the personality is that I saw a poll. They ran a poll like, what would you rather own, regional banks or REITs? And I was like, phew, that's a good question. Like,
can I have a C?
Can I get neither? Do I get the neither option? Anyway, but yeah, it's definitely an issue. But let's turn the attention right now to banks, because you brought a few charts.
Yeah,
and let's talk about the U.S. banking system that I think is fairly important. The first chart you brought, let me go ahead and or bring this up, is about the discount window, and there was just a headline just about 30 minutes ago that said Fed reverse repo use falls after biggest 2-day jump this year. But this is a staggering, like, you look at this, and I don't care what you're looking at, that is jarring. Even if it is. Yeah. Okay. So
that actually understates it. The actual number was 300 billion, not 150, but that's the only chart I found that showed that. But you can see relative to 2008, it dwarfs that. And so when banks get under stress, they go to the Federal Reserve and borrow money at the discount window.
Yeah.
So to me, this is one of the real important things to monitor. My assumption here is if this crisis is going to escalate, these numbers are going to stay high or go higher. And if it's going to recede, we're going to see those numbers come out. And they come out every Thursday, I think Thursday afternoon. And that's going to be one of the things to monitor. And the fact that it was this high, to me, was like, this isn't going away overnight here, folks.
Right. It wasn't like this.
Yeah.
Right.
Yeah. That's like a hiccup type of thing. So to me, this is one of the things that in terms of a stress indicator on the banking system, also a measure of confidence, because if confidence continues to deteriorate and deposits are getting yanked out, and part of it is, you can get 4.5% all day long in a money market these days. And I think at most banks, you might be able to get 0.5%. In terms of liquid, as opposed to tying your money up with a certificate of deposit for a year and 2 years and so forth. So there's a real mismatch. There's a great incentive for people to take their, savings out of a bank, paying so little and going somewhere else. What's going to happen, this is another negative for the banking system, to keep assets or attract, most importantly, keep in the short term, they got to raise how much they're paying people. Well, that means their profit margin squeezes. So anyway, this is a key number to watch. In the late 1970s, early 80s, when that inflation thing was going crazy, every Thursday afternoon, people were looking because they would report the M1 money supply numbers. And literally everybody would stand around waiting for that number to come out. And it was after the market closed. And I think the same thing's going to happen now with the discount borrowing.
Wow. All right. Well, the next chart you brought is regional banks. So explain to us what you're seeing.
Yeah. This is the ETF, KRE, regional banks. And, forget some of the, just look at what's happened in the last month or so. You see one down, two up, and you see this just, rather dramatic decline. It bottomed at 41.92. And to me, all the bouncingness that's happened over the last week is some kind of a wave four. So my take is, I think there's another decline coming below 41.92 to at least complete what might be only wave 3 of a 5-wave decline. But if we're going to have a decent short-term rally in the equity market, it basically, I think this has to get below 41.92 and then rally back up, wave 4 lesser degree between 46 to 49 before wave 5 takes it lower. So to have a sustained rally, I think what's going to happen first, Blake, is we're going to see the regional bank flush under that low from a week ago, and then a more significant rally. What could cause that? Well, if they decide to increase the deposit insurance from $250,000 to 1 million or whatever the number turns out to be to really calm the waters, that would be the type of thing where you could get a very nice, strong rally from under 41.92 up to 46.49.
Yeah.
And if that happens, there'll be a huge sigh of relief, and not just the regional banks, but the overall market would rally pretty smartly on that.
Well,
So,
taking that into consideration and just putting two and two together, your next chart is the dollar. And so that would suggest that the dollar would probably come under pressure if something like that hit the wires.
yeah, and that's why the dollar is at kind of a critical level, this 101.90. I wrote about it on Monday, like, okay, I need to hold above that. My expectation is we are going to see a rally above the 105.88, that this was a pullback, and then we're going to see another pop. And, again, this is make or break time for the dollar. Obviously, if it does, in fact, follow through to the upside, again, flight to quality. If the regional bank index goes to a lower low, that might provide, a flight to quality to the dollar. But that, this is where technical analysis can just hopefully provide a level of risk management. My belief is the dollar is going to make a low here and then rally again. The news will provide whatever juice it needs to, to make that happen.
Yeah, I was gonna add, Jim. I mean, during times of extreme stress in the market, technical analysis, you almost take the playbook and throw them out the window and just look for, like where, how am I going to protect myself in trades? And that's really what it boils down to, right?
Yeah. And like the KRE, hey, it gets below that 41.92. For somebody who wants to be an aggressive trader, that's probably a good entry, looking for that sharp rebound to occur. You don't see that, if you're just looking at fundamentals. You just won't show up on the radar screen and how to protect yourself. So again, we're in a very fluid situation. So it's what are the goalposts that we need to be watching to get clues over a very short period of time. And to me, paying attention to KRE is important, because I think sooner or later it's going below 41.92.
Okay. All right. Well, and it's obviously put some pressure on gold. I mean, you took this chart just a little while ago, but gold is actually trading above 2,000 as we're speaking right at this moment. It continues to surge higher. And like I said, this chart was probably from earlier this morning. We are even higher now. So
Yep. So again, from the lows last September, 1, 2, 3, 4, 5, when we talked last week, I'm like, hey, I think we're going to see a pullback. I still feel that way. Because sometimes, you get that sharp drop, which we saw, I think it got up to 2007 or so.
Yeah.
Last week, and then you had a pretty good hit. That could be A down. This is a B up. And then you get another pullback. The main message from last week, and I've talked about this really off and on over the last 2-3 months, was that if gold did a 5 up here, which it clearly looks like it has, if it got above that high in January, which is 1959, to get that fifth wave, to me, that kind of confirms we're going to see higher prices in gold over the next year, and going to a new all-time high and so forth.
Yeah.
What does that, I'm not going to try to infer like, okay, that means later this year, the Fed's cutting rates and all the rest of it. You don't need, to me, the chart pattern is it. So given this, if there is a pullback towards 1850-ish, and that's just a 382 of the whole rally from last September, to me, that's like a buy point. Wave 4 of lesser degree, that low would be another price target. The idea here is wait for weakness to come in. I wouldn't be chasing it here. But, again, if the wheels start to come off, and maybe gold is going to just motor while KRE does go to a new low. But again, the pattern suggests to me that gold is going to new all-time highs. And I said this last week.
And you did say it last week. That was really my takeaway from last week as well. All right. So we got the S&P here. We've seen obviously a lot of volatility the last couple of days. How are you reading this mess? Because, I think it boggles a lot of people's minds that the market's holding up as well as it is.
Yeah, it's holding up primarily because of the NASDAQ 100, the mega cap stocks. which, have a weighting, I think, of 18 to 20%. And the logic there is, okay, treasury yields have come down, therefore valuations can get stretched on the mega cap stocks. And that's the whole logic. And as they've rallied, I thought that the Qs could get up towards 325. This morning they were at 310. I don't know where they are right now. But that's what's holding up the S&P. And think about it. The Russell is making multi-month lows, and the Qs are making monthly highs, it seems, or close to it. So that's the dichotomy, and the S&P is kind of in between. The bottom panel is an oscillator based on market breadth. When it gets below the green line, it says, hey, we're oversold. We're going to get some kind of a snapback rally. And, for the last 2 or 3 weeks, I think we're going above 41.95. And I still think that as long as you hold 3,800, I think the odds are we're going to see a pop. And, there's a narrative that could take hold from a standpoint of, if the regional bank stuff is contained, all of a sudden it's, hey, that's going to stay the Fed's hands. They're not going to be raising rates much, if at all, going forward. In the near term, are we going to see the economy weaken significantly because of what's happening with regional banks? I don't think so, not in a meaningful way. And so you're going to still get numbers out of the economy that are decent. And all of a sudden that means earnings are okay. Well, that's like Goldilocks. The Fed has gotten to where it's going to go. The economy is not in a recession. Earnings are going to be okay. Time to buy. So to me, that's been the scenario that I think can develop out of this. And like I said, if the regional bank stuff is contained, it opens the door to this other stuff. And, the other thing I will say is, during some of his comments he made yesterday, labor market extremely tight, inflation still, way too high. These are things he's been saying for months and months and months.
Yeah.
So, it's the old, on the one hand, a lot of the things that we're concerned about. And as you noted, 2 or 3 weeks ago, the debate was, are they going to go 50? Are they going to go 50? Because the data had come in, pretty decent.
Yeah.
So I think they're just trying to buy some time, doing the 25 basis points. They didn't increase the dot plot. They kept it at 5.1, which kind of says out there's one more rate hike. But as we've talked for really months, the key here is, I think the Fed is going to get the funds rate up to a level and then hold it there for an extended period of time. And because they don't want to repeat the mistakes of the 1970s, and Powell has said this, it would be an error to ease too soon. And I think that's their bias. So unless you have a banking crisis or financial crisis going on because of a lack of liquidity and so forth, their intent is to hold off and wait.
Yeah.
And, they're providing liquidity to deal with this regional banking thing. As he said, it's he thinks it's one-off. I think that's not a completely unfair assessment, because SVP, I think they had 93% of the deposits were uninsured. Wow. So as soon as the warning signal started to flash, you push a couple buttons and you've moved your money out of that bank. You didn't have to go stand in line to get it out. You pushed a couple buttons. And so again, I think if push comes to shove, they'll increase the deposit insurance. And I think they're just holding and waiting to see, are we going to have to do that? And if we do, let's hold back until we really have to do that. Sure. So again, I think there's a pop coming in the market, but the other shoe to drop is going to be the realization that the economy is going to slow. Already that's in place in terms of the yield curve inversion, leading economic indicators, banks increasing lending standards. And now all of a sudden you have another big segment of liquidity providers in terms of small banks that are going to be more aggressive in terms of tightening lending standards. I mean, to me, a recession's coming. It's just going to be a question now of, is how shallow or is it going to be worse? And we won't know until you get into it, because then, once things slow down and cash flow starts to, shrink for some companies, all of a sudden exposes other problems. Yeah. That's typically what happens.
Right. Well, one of the calls you've made really well is TLT. The bond market really bottomed a few weeks ago, and you even send out special reports to your client base, because I get those reports as well. And you were buying right down there, and we've seen TLT just rally. So this chart, obviously I want to hear your thoughts, but based on what I see here, and I see red lines and I can read them, and I can read 115 to 117, seems like you're looking for higher prices. That means lower yields.
Yes. I mean, again, going from the low we saw last October at that 91.85 on TLT, it rallied to 109 and change. As you can see, I have big wave A. And then we had a down, up, down into late February, which to me, wave B. And if wave C is equal to wave A, that's how you get to the 115, 117. You and I talked about this. I just wanted to kind of put the annotation on the chart itself. So, getting above the 109 to the 110 area on a closing basis, says that yields are going to be coming down. And so, here's a market that's saying, potentially a yields drop that much that TLT is up to 115, 117. I don't think that's because things are going well with the banking situation. There's a flight to quality there. So, what I've tried to do this week is just, hey, what are some of the key levels for the various markets, to give it kind of all right, if this happens, then that's good. And if that happens, it's not good. And so to me, I thought, basically, I told my subscribers on Monday, if TLT gets under 103.75, buy it with a tight stop, about 1.5%, because then I think, boom, you got that pop potentially coming. The charts have to tell us which way it's going to fly.
It's a very fluid situation. And Jim, I have to say thank you for keeping all of our heads on straight and on a swivel at the same time, knowing what to look out for. What's the best way to follow your work?
Macrotides.com. Send an email to Jim Welsh Macro at Gmail, and I'll send you a recent letter so you can get a better idea of the work I'm doing.
I would take advantage of that if you can. All right, guys and gals, I want to thank you for joining us today. If you enjoyed this exclusive content from Mr. Jim Welsh, make sure you give him a big thumbs up. Subscribe to the channel so you don't miss these weekly videos. And Jim, good luck for the remainder of the week and weekend.
Thank you.
I'll catch you next week.
You got it, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.